All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have Chris McIntyre. Chris is the founder and CIO of the aptly named McIntyre Partnerships. Chris, how's it going?
Good. How about you?
Doing good. Hey, well, let me start this podcast the way I do every podcast, and that's by pitching you, my guest. You know, I was telling you before the show, it's kind of weird. We've been emailing for years, and this is the first time I'm actually putting a face to an email address. But Chris, we've been emailing for years. Chris is one of the sharpest investors I email with. You know, he runs the portfolio that I love to see investors run. I probably get a little bit too distracted to run this at all times, but you know, it's 5 to 7 names, very concentrated, good work, differentiated view, and I just love that. So I've enjoyed talking to you over the years, and I'm excited to have you on the podcast today.
Thank you very much.
Cool. Well, hey, that pitch out the way, let's just turn to the stock we're going to talk about. This is a stock, you know, I've been following them for several months. There's a lot of background here. I know they were pretty popular on FinTwit, maybe a little bit because I was posting on them, but the stock is GTX. We'll just give it a quick disclaimer. They just emerged from bankruptcy. The stock is still pretty thinly traded. Both Chris and I have positions in GTX, so everybody should keep all of that in mind. Positions, recent bankruptcy, decently liquid stock. But with that disclaimer out the way, Chris, I'll top it over to you. What's going on with GTX and why are you so interested in them?
Yeah, so I like to always break and explain. I always split my kind of stock pitches between the long-term stuff, which we can definitely talk about, like the business, where it's going over the years, and then I also just like to kind of start with like trader talk. Where's the stock? Kind of what's the setup a little bit.
Love it.
So the basic setup, is it's the pitch is it's a recently reorganized company, and it's actually a high-growing, high-quality business that basically reemerged from a non-fundamental bankruptcy, meaning they run out of money, and we can talk about that later. But so it went through this non-fundamental bankruptcy, and after a period of yelling and fighting, which I know you've covered a bit of, the stocks reemerged, and basically it is an auto-supplier trading I think roughly 5 times this year's free cash flow, 4 times next. The clearest comp is Borg-Warner, trades 13 and 11 times. They have similar leverage. They have similar long-term worries about, internal combustion engines versus battery electric. And so I really think it's basically getting along this high-quality company that went through this non-fundamental, very fundamental event. And you're basically just getting a chance to buy it before everyone else figures out that it should really be trading a lot higher than it is. And so that is a very simple, short kind of trader talk pitch. It's a pretty clean balance sheet now. It's a pretty clean business, and yeah.
No, that's a perfect background, a perfect overview. And I've got, look, I've been following them. I think people are going to guess some of the pushbacks I'm going to have, but we'll get to the pushbacks in a second. But I guess let's just take another step back. You mentioned Borg-Warner as a comp, but what particularly does GTX do? And, how do you look at this business? Because I do think there's been a little misperceptions on probably the business and how cyclical it is as well.
Sure, yeah. So the business is turbochargers. And it's actually, it's one of the deepest moated. One of the reasons I like it so much is it's really we talk about moats and what they are, but it really has one of the biggest moats I've ever seen a company really have. They have about 35% share of the turbocharger market. They and Borg-Warner basically share a duopoly with roughly 70% combined share. And then there's some smaller Asian competitors that actually chase after them. But one of the things I always like to point out when talking about what they do, what it is it's an auto supplier, and so it's a part of an engine. And so what actually it is, there's a couple that chase after them, and so they're a fast follower market. So there's 2 leaders who basically are several years ahead in R&D, and then there are smaller Asian competitors who try to knock them off, and a couple of years later come to market with a thing. But they have basically the highest margins of any non-software auto supplier. I mean, among the highest, at least. Maybe there's a niche product here or there, but they're very high margins. They're basically an 18% EBITDA margin, something like a 15+% EBITDA minus CapEx margin. Average auto supply margins 6-7% with 3% price downs, versus these guys are at 15+ with 1% price downs. And one of the things I also like to point out to people is that Bosch and Mall, which are basically 2 of the largest auto suppliers in the world, in the late 2000s, they actually tried to get into this business, invested several $100 million in startup expenses, 10 years, complete buy-in from the OEMs trying to break this duopoly, and they gave up. They actually sold it for, almost basically cost to Chinese private equity a couple of years ago. And so we'll get into the product in a second, but it really is one of these great, excellent businesses. If it weren't for eventually the threat of battery electrics, which I'm sure we'll talk about, I would say it's one of the best companies I've ever analyzed. And so what they make are turbochargers, which are basically, conceptually, it came out of Honeywell originally. And they're sort of basically, they're basically mini jet engines. Like, you know, like when you look at a plane and the jet engine in the front has the turbine that spins, exactly the same thing, except it blows, it takes the air that comes out of the engine and blows it back into the engine. And so that causes more power. And so a lot of people historically think about turbochargers as like, you know, like Fast and the Furious, you know, racing down the highway, turn on the turbo, nitro, whatever, you know.
Instant first thing I thought when you mentioned,
Yeah.
when we started looking at these, for sure.
Yeah. So that's like what turbocharger means to me before I knew about the business. But the flip side of that is if you want to also increase gas mileage, right? You're taking the air that's coming out of the car, it has force and isn't going anywhere, it's just going out the muffler. And you're pushing it back in the engine, so you're conserving power in that way. And what it does is basically they're a big play on hybrids and like fuel efficiency, because what you can do is you can go from a 3-liter engine to a 2-liter engine. But when that happens, you lose a lot of power. And then what you do is you add a turbo, you jam the air back in there and you get your speed back up. And that way you have 55 miles an hour, 55 miles per gallon. And you don't take 15 seconds to get to 60 miles an hour, the way like a 1.5-liter engine, like some of these turbos or some of the hybrids currently have, would have without turbocharging and some of the other powertrain electronics that they're adding to it. So it's really just this big play, taking a step back, it's kind of a big play on CO2 efficiency in cars. And so 47% of all cars in the world were turbocharged. Not all of the park, just all of the like new cars made every year were turbocharged in 2017. And now it's like 51, 52. In 2023, it should be like 53%. And so it's just a very clear line of sight on that growth. And the other thing that's really, really interesting about Garrett and about turbos thus, is they're really designed into the cars, and they're designed in years in advance. Like no car is going anywhere without the engine, right? It's just a very basic concept, right? And they design the engine a couple of years in advance, and basically Garrett bids on these contracts 5 years, 4 years, 3 years before they actually come to market. And once it's designed into the car, I mean, it's literally, you have to like design it into the engine, right? You can't just like swap them out. And so they just have like a really sticky, high visibility model. And they're selling into a cyclical market, auto. But the thing that they're selling is like, they know that, you know, the Mercedes, AMG, you know, GLC, whatever exactly it is, like they know 3 years in advance, they're like, all right, you've won the contract and every single one of them will have it. And so they actually, they're 35% of a market that's 50%, roughly speaking, of the overall car market, right? So they're diversified across geography, they're diversified across OEM, they're diversified across model. And so really the key variable is auto sales. It's not, if the F-150 doesn't launch well this year, it's not like their earnings numbers go down 30% or something like that, like certain other auto suppliers might. And so it's really this like sticky, high barrier to entry, you know, growth story, frankly, because, you know, CO2 efficiencies are going up and that's the law. And we can talk about battery electric, but it's currently not a nearly large enough part of the market to really move the needle. And so they just kind of have to go to like these hybrid fuel trains.
Well, I'm a little pissed because you front ran all of my questions, all my fundamental questions with your answer. But just to sum up, make sure, and so that listeners think I'm smart when I'm summing all this up and everything. But I think the basics of the investment thesis here is, hey, these guys they should have years of pretty good visibility, because if you've ever worked with a car manufacturer, and this is not unique to them, but car manufacturers, as you said, they build for their platforms years in advance of making the cars. And once you get in, you know, SiriusXM is a popular company among FinTwit because of Malone's investment. And they say, look, we'd love to be in every car we can, but unfortunately, if you bid today, you're bidding to get into the 2024 and 2025 models. It takes 3 or 4 years. For these guys, they bid, they get into an engine, it's 3 or 4 years in advance. They'll be locked on that platform for 5 or 7 years, however long it lasts. It's a duopoly, as you said. Them and Berg Warner control the, you know, 70-ish% of the market. So duopoly with lock-in and long-term visibility, you combine those three together, and that's the recipe for a good business. Is that a pretty good summary?
Yeah, and I would even like, a lot of auto supply has like a duopoly characteristic, right? Like let's say seating. But the thing that's even better, I would say, than most of auto supply's duopoly kind of thing is like, the way I pitch it is like, like if you and me take $50 million, we will be able to figure out how to make a car seat, right? Like I'm not saying we can deliver it just in time on a scale of millions of units, with, 10 days notice between like the order to delivering it anywhere in the world. Like that's a very difficult thing, but we will figure out how to make one. Like turbochargers, the turbine, so like the thing you see in the front of the jet engine, it's much smaller, obviously. It spins at like 150,000 rotations a minute. And the distance between the turbine and like the wall of the turbo sometimes is like 1/7 of a human hair. Like you're not just getting into this business. You can't throw money at it. You need years of know-how. And so like a lot of the times you see an auto supply is like there's a 1 and a 2, but like the OEMs do a good job of keeping a 3 or a 4 on the margins to like make sure that like the 1 and 2 don't get enough size and run away with price, And so they're always like, oh, we'll just give it to your competitor. And you're like, no, we'll do it at a 20 gross margin instead of 25, right? That's really not the case here. It's really just Borg and Garrett that can make the first gen stuff. And so like there's only 2 companies bidding on these. And so it's a little bit, I would just argue it's even better than most duopoly auto supply things.
I do not disagree with you. Oh, is that on my end? Okay. I do not disagree with you in any way, shape, or form, but let me provide some pushback. We'll talk about the bankruptcy and why and how the bankruptcy happened in a second, but there was a bankruptcy, and in the bankruptcy, there was, as you do in a bankruptcy, they ran an auction, right? And the auction resulted in initially KPS, a private equity firm, bid 2.1 billion. They walked up to 2.6 and maybe walked up a little higher. There was Centerbridge, the party that ultimately won, with a recap bid that I think valued the company around 3 billion. And then there was a kind of equity holder committee that tried to get a bid together. I think that failed at the 1 yard line. But there were 3 bids in the 2.6 to 3 billion range is what I'd say. And when I look at that and I say, EBITDA here, I think you and I think in the short term, in the medium term, probably can get to around 500 million. So this is a 6 times EBITDA business. You can correct me if I'm saying any of this wrong in a second, but when I look at those numbers, I say, oh, okay, like cool. You had a business that goes for 6 times EBITDA. Like it went through bankruptcy, ran a process, and these were the best bids it can get. Like those numbers aren't exactly jumping off the page to me as this is a really good business. So how would you kind of respond to that?
So the simplest, so how much do you want to talk about like the bankruptcy process? Because we can talk about it, but it kind of explains how the bids came in, but I don't know how specific you want to be.
Let's go to the bankruptcy process in 1 second. Let's just stick on that kind of valuation focus I had for a second, and then we'll go to the bankruptcy.
Yeah, so I would say, so 2 things on the valuation focus. One is I think they filed at a time when auto supply was still in question. And so, you were going to lockdowns, what are things going to look like? And for a variety of reasons, I think Garrett management, as we're talking about bankruptcy process, you're very specific on who we were talking about, but Garrett management was very conservative on their forward guidance. And so I think so for instance, the first pushback I would have is like the $500 million number, where they are already much ahead of all of auto supply. Basically, they're already at like record profits. So they're actually breaking up to new highs. And so if you just take their Q1 number, where they did about 176 million in EBITDA, and you annualize it, you're already at roughly a 700 million pace. And so like the numbers from when they filed that many people I think were looking at through the process are completely wrong, and they're coming in well ahead of them. And the second thing I would push.
I was just on the numbers. I remember one of the filings was like, hey, here's our 2021 projection quarter by quarter. And they had just completed Q1. And there was like a footnote that said like, oh, our 2021 projection, like we smashed the Q1 estimates. We're so far ahead of it. It's ridiculous, but we're keeping our 2021 estimates. And I read that. I was like, wait, what?
Yeah. They're running a process. They're dealing with lenders. There's only downside to overstating your number to a lender. So they just, I think for a variety of reasons, are just quite conservative. And they've been coming in well ahead of what I think some people might have looked at it and heard previous, your podcast, or took a shot at it in the bankruptcy court. They're coming in well ahead, which I think is an underestimated part of the story if you're thinking about like a trading perspective on what is actually playing out in the market right now. And then the second pushback I would do is their EBITDA minus CapEx is like 15. And like most auto supply, when someone throws like the 6X, they're at like a 7, 8, 9. And so they're actually just converting way more free cash flow. They also have a little extra, they have like an advantage tax rate. They're like actually a Swiss-based company. Engine design really happens before battery electric, almost entirely in Europe. And so they're just actually a Swiss company. It's actually quite difficult to get a Swiss tax rate. You can't just plop down and try to apply for it. It's not like certain other countries. Like, so they actually have an even better tax rate. And so like they have higher margins and lower taxes. And so like the free cash flow conversion from comping them on EV to EBITDA to say Borg Warner, like they're converting at a much higher rate because Borg has this business just like them, but then they have a bunch of other lower margin businesses that blend down their overall EBITDA conversion. So I think those would be the two pushbacks on just a straight EV to EBITDA calculation, why I think it's a little bit unfair to Garrett.
No, that's great. And we'll turn to the bankruptcy in 1 second. I'll just interject one more thing here, because the thing I've struggled the most with it is I look at it and I say, oh, I think this is cheap. I think it's pretty clear that they're going to blow away numbers. And aside from you, me, and a couple other people, I don't think people are talking about, hey, you know, the 2021, like that you could probably cut out Q4 and they might hit their 2021 numbers at this point. So I think it's super cheap, but the like kind of incentive driven event investor in me looks at it and says, well, 3 parties shopped it. This was the best bid. You know, I do think the controlling group, the Oak Tree group that ended up taking this, they really wanted it. But I look at it and say they won with the best bid. And right now, if you're buying the common stock because of the way the prefs work and everything, you're probably paying the topping price to the best bid. So, you know, I kind of look at it and say, is there that much upside here? But that's just the event investor in me, because I think the numbers speak for themselves. Let's turn. The first pushback anybody's going to say when they look at this, they're going to say, you guys are here saying it's a good business. You guys are out here saying they've got years of visibility. They went bankrupt last year. So what happened with the bankruptcy?
So I like to pitch it by taking a step back and saying that there's basically 3 reasons a company files for bankruptcy, right? The first is they can't make their interest payments. The second is they can't refinance their debt when it's due, either because they tripped a covenant or because whatever's happening, like the credit markets are not open to this company. And then there's option number 3, which is contingent liabilities, which is what Garrett is. But number 1 and 2 are basically what most people think of when someone files for bankruptcy, right? It's like, we ran out of money. We don't have any more money. We're bankrupt, right? That's like what it means. And so, you know, I've done distressed debt many years. You can make money in it. There's a whole business out there trying to make money in that. You have to be a quib for the most part, which is a different thing. But the problem with those bankruptcies is, look, you're almost always screening for bad companies, right? Bad companies or idiotic management. Like that's how you end up in bankruptcy, right? With certain rare exceptions. The third one, which is contingent liabilities, like the filing has nothing really to do with the business. So they filed because they had a disagreement with Honeywell about some liabilities that were put onto the company when it was spun out of Honeywell. But the actual liability that we're discussing is their asbestos liability, which is related to a company called Benedict's, which is not even Garrett. It's just something else that was in Allied Signal when it was acquired in the late 90s. The point is, like, they stopped making these brake pads in like 1982. Like, it has nothing to do with the business. It literally is older. I'm not that old, but I hope not that old. But like, it's before I was born. And so it just has absolutely nothing to really do with Garrett's fundamental business, which I think is like the interesting thing about Garrett specifically, and contingent liability bankruptcies in general. Asbestos, some famous distressed debt trades from like the early 2000s, where certain now famous investors bought a ton of like equity in certain companies. And then, you know, there's the wildfire fires in California, which you can argue maybe is more ongoing, but like certainly like whether or not like there's a legal liability from wildfires not related to whether or not someone uses a lamp in Los Angeles. And so it's really, you know, it's a bankruptcy, so it's lumped in and like, oh, it's a bankruptcy, it's probably a crap company. And you're like, no, this bankruptcy has absolutely nothing to do with its current operations. They're totally different. They just have nothing to do with each other, which I think is a real opportunity to get, you know, an actually very good company that actually is going through this process. I don't know if you want to interject there or.
No, that's great. So I guess the summary there would just be GTX spun out of Honeywell at the time, and Honeywell did this with another company too. Honeywell spun them out, and part of the spun out was some weird financial engineering where Honeywell said, hey, we've got these legacy liabilities that have nothing to do with you, but as part of the spin out, you take these liabilities, pay them back. And it was actually structured in a really weird way where it was a liability for the company, but it wasn't tax deductible. It was strange. But Garrett, in 2020, they looked at it and said, hey, if we file for bankruptcy, we think we can take a huge haircut to these contingent liabilities. So is that kind of putting it correctly?
Yeah, I think you can talk about what exactly went. I think that's definitely putting it correctly. You talk about what exactly went down between Garrett and Honeywell. But yeah, basically by filing for bankruptcy, you were forcing someone to settle. We can like drag out a fight in court for many, many years, right? But like when you hit a bankruptcy court, you know, the way it works in bankruptcy is like, if you have debt, you show up and you're like, I gave them $1 billion. I want my $1 billion back. If they don't give me my $1 billion, I'm going to be a creditor. And then there's a whole thing. But like the way these liabilities were structured, they're basically an indemnity. And so like, actually they're like, Garrett's not on trial for the asbestos. Honeywell's on trial. And then Garrett's indemnifying Honeywell. And so the thing is, when you file for bankruptcy, you say the contract is worthless. And so like Honeywell has to accept whatever the bankruptcy court puts on the contract, or they accept zero. And so like, you're forcing someone to settle rather than like dragging it out with years of appeals and, you know, all this kind of stuff. And so, yeah, they took the route of forcing Honeywell to the table. Maybe we could have come to a conclusion without going through a $400 million bankruptcy. But that's how it went. And so, yeah, that's basically it.
Perfect. So I think that's a great overview of the, I think that's a great overview of the bankruptcy. We probably don't need to talk about why they went into bankruptcy court anymore. I think both you and I would say the whole thing could have been handled better, but they went into bankruptcy and then they run an auction. And, you know, I was saying my worry is the auction didn't produce results that were a lot higher. And I think if you think the stock's really going to work, you need the auction results that have been wrong, this to be a lot higher. So maybe we can talk about the auction process for a second and kind of why you think that might not have yielded full value for Garrett versus what you're seeing today.
Sure. So the sort of like the critical part of like the auction is, well, what is Honeywell going to get? Because essentially, right, like if you're coming in as a third party bidder, right? So you're just
and the reason that's critical is, you know, KPS, who was the original bidder, their final bid was about 2.6 billion, and Honeywell was owed about, what was it, 1.5 billion, right? So 2.6 billion versus 1.5 billion. The reason you say what is Honeywell is going to get is because they were owed so much money that the haircut on that side was the most critical thing to this bankruptcy.
Yeah, it's basically, it's really, I think actually KPS's final bid, I think it's more like 2.9 something, just apples, apples that are whatever I'm looking for. Yeah, so it's just like a huge part of it. And it's also like the reason, so basically what happened is through the process, there were a bunch of different recap proposals, some talked about in court, some officially filed in court, whatever, right? Like a lot of people, and also I'm sure plenty have come to stress funds poked on the sides that we don't really, never got filed, never really talked about, but I'm sure someone asked Honeywell what they want for it, and, you know, we'll write you a check kind of stuff. The reason it's critical is what happened is Centerbridge and Oaktree, who ended up winning, basically went out and locked up, let's say, Honeywell basically into this like sort of like settlement. And like the bankruptcy judge took a dim view of it very publicly, you know, kind of like challenged it and said like, how is this not anti-competitive? You know, very much said it. But what it really does is, the problem is, so say you're a separate private equity fund, right? You're, you know, let's not use an actual one, I guess. So your ABC private equity fund, right? And you're like, you know, I think this could be worth like, I think if I buy this for 3.5 billion, numbers could come in better. You know, we could see a way to get over this sort of thing, right? The problem is you need Honeywell to settle. And Honeywell has agreed only to settle with Centerbridge and Oaktree. So I don't have that settlement. So then I have to run the risk of like, I have to overbid. So I have to beat Centerbridge and Oaktree, which are two very large, well-funded, well-respected private equity hedge fund, whatever exactly you want to think of them. So I have to beat two of my large liquid competitors, not liquid that way, but having liquid lots of money competitors. And then I don't have a settlement with Honeywell, so I don't actually know what I'm buying.
Yep.
Right. You know what I mean? I don't know if I'm paying 3.5 billion and I'm buying $1 billion in equity, or if I'm buying 200 million in equity on top of it, or maybe if I'm actually not going to win and they're going to say Honeywell is due more than that. And so I'm, you know what I mean? Like it's a really complicated thing. And so what it did basically is and the judge, you could just, I guess there will be a transcript at some point available, I believe. But if you've actually listened into the hearings, right, like he was very much like, you know, it's not just my opinion that this is anti-competitive, it's sort of anti-competitive. And so it's not a real go shop period, because basically within a month of filing, it looked pretty obvious that the equity was going to be, you can see it trade up, right? It looked like obviously it was going to stay listed, right? Like multiple parties agreed to keep it out there. And so it's sort of like, so now you have to bid higher for that. And it just made it not, in my opinion, a fully real auction. And I would point out that outside of KPS, all of the other bids were like people who are shareholders bidding to recap the company that were made public in, like, you know, Owl Creek had one with the Moreland or Jeffries Group, OWJ. And so it's not, it was a somewhat intentionally not competitive auction. And I think that's a really critical detailed thesis, because it's like, they're like, well, that's the market clearing price. That's what we got. And it was like, with the caveat that the most important thing was locked in by one of the bidders who has no incentive to gun it because they think they've locked in the most important detail. And so they're going to win no matter what, which is actually what happened. So I think it's a little bit different.
That's perfect. That's perfect. And let me move to, I think the next thing. So Centerbridge and Oaktree, and I'll just do a quick thing, but they locked in Honeywell, and then they structured the way that the company basically eventually emerged, and they had to tweak it around the edges because there was a competitive shareholder group that basically forced them to. But I would say the way they emerged was with a rights offering that highly advantaged the Centerbridge Oaktree group, right? So when I go through those two, now the companies emerged, but they emerged with Centerbridge and Oaktree backed them. Centerbridge and Oaktree owned the majority of the common equity. They own the vast majority of the preferreds at this point. So we can talk how we value it and everything, but I think the biggest risk that I'm worried about, aside from being wrong on the valuation right now, would be, hey, Centerbridge and Oaktree, they're private equity firms. They are here to make money for themselves. And I think we're kind of aligned because we own the same securities at this point. But at the same time, the bankruptcy process showed that they have no qualms taking a knife and shoving it into minority shareholders' kidneys, because that's pretty much what they did the entire time through this process. So how do you think about kind of those controlling shareholders?
So I think they're the new money investors in a bankruptcy process. And they own, the way it works is they own 4.9% roughly each of the company, like one share shy of 5%, not literally, but in the ballpark. And then they got to put in the recap. So they mainly own the pref. And so I don't want to talk, we can talk about the pref, but like the pref is like super liquid right now. It will be listed later, but so you can think a couple months out, but there's going to be some restrictions on who can actually buy the pref now, but will go away in July. The way I think about it is like, yeah, you got to think about what they own. And there are certain ways that they can maybe advantage their piece of what they own versus your piece. But ultimately, they still own upside from 5.25 on the pref and their shares, right? Like that is the big way that these guys are going to get paid. There's way too many involved third-party shareholders who are not Centerbridge and Oaktree who also own a piece of it. For I think if they owned 80% of it, I think I would be a lot more like, all right, I'm going to own 1%. Or, I'll own 3% of the available 20% or something like that. And you're like, okay, there's certain things they could do. They could put like a private equity style, in theory, they could put like a private equity style, management fee or something like that, like sweep out 3% of the cash to themselves. There's sort of like things you could do, but there's so many other funds involved who are also big, like you can't push them around quite as much. It's a pretty well-trafficked name. I think one of the interesting things about it is if you look at the shareholder list, it's like for lack of a better phrase, like a who's who of distressed debt investing have all shown up as shareholders and or bidders for the entire company, which might hint potentially at why that there might be a value there. Like it feels unlikely that Post has Cyrus, Warlander, Centerbridge, and Oaktree all are incompetent and they're all wildly off that they all thought this thing was interesting. So I think that's maybe a little bit of a bullish argument, but I think the thing to get comfort in is I don't think you really have a high likelihood of, if they were to come out the way that I think they would get screwed now is they would we'll bid $7 for the rest of the equity. And so that would in some ways be bad, or they could come out with a lowball bid, but then there's still going to be majority minority shareholders. So you still have to get that and you'd still have to run a real auction. And this time it's not quite as, you can't just, it wouldn't be as lopsided as sometimes new money injections in bankruptcy are. I think new money injections in bankruptcy are particularly sometimes lopsided. There's all kinds of horror stories. You can find all sorts of smart guys screaming on the courthouse steps that their bond's worth more than they're getting, and they still end up getting the price that was originally agreed upon, versus it's a different thing with a publicly listed company. And I'd also point that they own so much of this, and this is such a big bet for them. And it's also okay, are you really going to get, does Centerbridge and Oaktree really think they're going to screw Post? Who owns, I don't know exactly how the proration came out for their, the backstop on the pref. But do you really feel how much are you really going to get chasing out retail accounts when 80% of this is now owned by a bunch of funds who are quite knowledgeable, at this point and do know what they're doing? It's not, the ugly part of this business sometimes is when people might take advantage of like, retail accounts and like a transaction that's unnecessarily complicated sometimes, right? Versus now it's like, there's really not that much left versus like the value of the public listing. And if this does well, they get to put, they can sell their stock in the public market. They don't have to do a private transaction. So I think we're actually pretty well aligned there. And the other thing I think, the flip side of it too, though, is, I don't know if you had a comment or am I cutting you off?
Please continue.
Yeah. The flip side of it, when you're dealing with like, all right, so we have like a big controlling shareholder, right? And you're worried that they won't treat you fairly. But the other flip side of it is, look, this is a company that inevitably in the next 20 years, let's say, I think their core business will be in secular decline. But it's very cash generative right now. And in my opinion, stock is very cheap right now. And so one of the critical things is like capital allocation, right? Like what's going to happen to the cash, right? And I think having a bunch of like skilled value guys who are pretty intelligent and have experience running deal processes, basically with like running the show on the capital allocation front, I think that's a very material positive. And so I think more than I would think an average stock that trades an average market multiple with a controlling shareholder I don't necessarily trust, like, I mean, like that's not great, but when something's trading 5 and 4 times free cash flow, having a skilled capital allocator makes a huge potential difference on your eventual outcome.
I couldn't agree with you more. When you've got something that's can you hear me okay, by the way? I keep hearing a little bit.
Yeah.
Okay,
it cut out a little bit, but now it's fine.
I just couldn't agree with you more. When you've got something that it's the classic, oh, this is trading for a 10% free cash flow to equity multiple. My biggest mistakes in my career have generally been, hey, this trade's really cheap, but I kind of don't trust the management team. And then guess what? The management team takes all the money for themselves. And like here, it's going to be tough for them to take all the money for themselves. At this point, I think you're aligned. And the most important thing is this is a business that generates a lot of cash flow. And because you're probably aligned, they're not going to go do a stupid diversification, or probably won't. If they do an acquisition, it's going to be the sharpest guys in the room at least blessed it. And more. And if they don't do an acquisition, they're not going to let that cash sit on their balance sheet. They're going to be putting it to work by giving it back to shareholders because they want to juice that RR. So I just love that you've got an investor who is in a semi-control position. They're focused on maximizing shareholder value. They make their living making money, and you're probably on their side. So I agree with you there. Let me ask about management team, because, I think both you and I are a little critical of the process that resulted in the bankruptcy. I think you and I would probably be a little critical of the initial KPS deal, the way they structured and joined the Centerbridge deal, all that. So, I do look at this and say, okay, you've got a management team that bungled a bankruptcy filing. They've been running this for years. Like, why should we trust that this is the team we want to bet on?
So, like, I think you can criticize a lot how things went down and like the way, it certainly wasn't the dream as an investor in the company before the filing. But through the process, I'll say like it still ended up, basically, what ultimately happened basically is like you took a $1.4 billion liability to Honeywell, or 1.5 or whatever exactly it was, at like a 9% or at a 7% discount rate called $900 million. And so basically they got $900 million and we equitized it at a 20% discount to where the stock was trading the day before they said that they were thinking about filing. And so you're like, it's not all that bad. Like it would have been better to get fully to participate in the offering, right? It would have been better to not, there's certain things that could have gone better. But I think ultimately it didn't work out all that poorly. And I think certainly if you are sort of knowledgeable and traded it well, it could have worked out pretty well. As I'm sure many listeners to the podcast or that follow you might have figured out.
Not investment advice, but I suspect that a couple might have.
Yeah. Some people might have done all right on that. But look, it's sort of like one of these things that happened, and I don't really like exactly all the stuff that went down, but I also don't think it's not like egregious, and then the way that I don't think personally that it's egregious in the way it finally went down. And then beyond that, they're actually really great operators. They have like extremely good reputations. The business, when it was like part of Honeywell, consistently won like best operating subdivision or what, like they got like the gold star at the kind of thing. I don't work at a large company, so I don't really know how these things exactly work or how they sound, but they're quite good on operations. They keep a lean corporate structure, like the actual, if you look at like the SG&A versus sales and all that kind of stuff, it's really quite lean up top. And they pretty much, with the exception basically of like the auto downturn, which is not like they created COVID, to the best of my knowledge. They do have a plant in Wuhan, but they, they were like really good operators. I don't really think, look, Centerbridge and Oaktree are basically in charge anyway. So it's like, if they're like guys who are going to give themselves too big of an options package, they've got a nice options package here. It's not as, yeah.
Do you know where do their options strike? I don't remember looking at their options.
No, if it's public or not. I assume probably they're going to strike at 525. CEO actually bought stock this week.
I hadn't seen that. My Form 4.
Yeah. It's a Form 4 filing. There's maybe some, I asked the company, I haven't heard back. There's maybe something around the contract, but I think it's basically just straight up public market buy. Yeah.
Cool.
But,
well, no, I think that's good. Yeah, it looks like a straight up public market buy. I'm kind of looking at the edge of my eye. Very interesting. Let's talk about, so I think we've covered the bankruptcy process at this point. Is there anything on the bankruptcy process that you think we should go back and hit real quick?
no, I don't think there's anything.
Okay. So bankruptcy process in the past, they emerged in the past month. They emerged through, it was a big Series A preferred, convertible preferred offering that they did that kind of funded their whole bankruptcy. They just got that done. The preferreds, I don't think they're trading yet. Hopefully they will at some point in the future. But as we talk, it is, what is today? It is Friday, May 14th. This stock is trading for about $6 per share. So can we talk for a second about valuation? And I know a lot of people have had questions on the convertible preferred A's, which will eventually trade, versus the common. So let's just talk overall valuation and then maybe how you look at the convertible preferreds versus the common.
Sure. So I think the easiest way to think about it is, and I know it comes out with a little bit of a funky structure, not that funky of a structure, but like a little bit. The easiest way to think about it is to just convert the preferred fully, and then think about free cash flow per share on a fully diluted share base. And the reason I say it's the easiest is right now it has the capital structures. There's a term loan, there's a pref A, which is what the recap is. I call it an equity recap, but it's really you recapped it via the pref, which is convertible at $5.25 a share. It's about 1.3 billion. And then they have a pref B, which is like basically Honeywell got $375 million last Friday, 2 Fridays ago, or whatever. And then they get this $584 million of present value. It has like 835 is the actual book value, but it's paid out over such a long period of time. At a 7.25% discount rate, it's more like 584 million. And Garrett has the right to prepay it at a 7.25% rate whenever they deem. They can also prepay the first 184 million without trigger. If they prepay more than 184 million, they have to basically, like Honeywell can be like, you have to give me all the money, but they can prepay the first 184. So if you think about like the simple capital structure, is the term loan, the pref A for 1.3 and 1.25, opposite, not respectively, the opposite of. And then there's the Honeywell pref B for 584, and then there's 65 million shares outstanding. And so I know it can be tempting to run like an EV to EBITDA like sort of calculation across this, but it runs into this sort of like somewhat ridiculous thing where like if you assume any kind of multiple on EV to EBITDA, particularly on a 1 or 2 year out number, you end up with saying like the shares are worth like, if you thought it was worth, say they're going to do 800 million in EBITDA, 700 million in EBITDA minus CapEx, which I think is a totally reasonable number by 2023, let's say. If you throw like a 7 times EBITDA multiple on that or something like that, 7 times EBITDA minus CapEx, which I think for any business is not already in like negative revenue growth territory. At that point, I think they'll be growing revenues double digits. You would be coming up, if you try to do this EV to EBITDA calculation, you'll come up with some sort of math where you're like, well, I think the equity is worth like $28 a share, but then it's going to get diluted at 525. So it's sort of a little bit of it doesn't really fully make sense. And then the second reason I think is look, the whole structure is basically designed to collapse at 600 million in EBITDA. So the company basically, originally we talked about like how their guidance is way too low to what the business looks like now. And so they were like, look, by 2023, we should be doing 600 million in EBITDA. And so Honeywell has a put option when the company hits a $600 million trailing 12-month EBITDA 2 quarters in a row. They have the right to be like, give me my money back now at that 7.25% discount rate versus 585 current present value. so there's the put option, and then 2 is like the actual pref A force converts at 600 million in trailing EBITDA, and the stock price has to be 50% above the strike, which is like 775, 780, something like that. But it's designed to force convert, right? And so the calculations they give to the court are like, here's what we think it'll be worth, it'll convert, and that's all 313 million shares outstanding. But the thing is, like, they're already way above that now. Like, they're already at like $700 million run rate, and like they grew, their sales are 19% above Q1 2019. Auto industry is down 13 versus Q1 auto 19 right now, and you're like, we're already above this rate. And so the thing is, like, either Honeywell is going to push capital to that, they're going to be like, we want our money back, or I think even without them asking for their money back, like, they're just going to refi this loan. They're going to kick off so much cash. They should exit with something like 500 million, let's say, in cash on the balance sheet. I think it might be more than that. And then they'll also, like, they'll probably generate another 400 million cash by year end. Like, I think there's just a very good chance, like, they either refi it or pay it down with cash on hand or whatever exactly they're going to do. Like, Honeywell's going to go away certainly within 2 years, if not by like the fall. And so once that actually happens, then you'll have just basically the common shares, which would be, 20 for whatever 65 over 313 is right now. And so you have the common shares will be about 20% of the equity, and the rest with the pref A, which will be listed and traded. And so I think we could talk about pref versus equity, but in relatively short order, it will be very obvious that the thing, I think, will be force converted. It'll take 2 years for the pref A has to exist for 2 years. You as a holder have the right to collect those dividends for 2 years before the automatic conversion kicks in. But I think it looks a little odd, but it should be cleaned up pretty quickly because they just have way more cash, and there's no reason to pay 7.25 when you could probably refi it at 3 or 4. So I just think it's a much simpler structure.
Cool. So let me break this down and try to simplify a little bit. So I think that, and I agree, the whole structure was designed to collapse and really simplify when the company got to 600 million in EBITDA. Whether they hit this year or 2 years from now, we can debate. But if I just said, okay, the company, the baseline target is 600 million EBITDA. The shares today trade for $6 per share. What's the company's EV at $6 per share right now? If you assume all the prefs just convert.
Okay, so you want with the pref conversion?
Yeah, let's just assume the prefs convert, and obviously you'd have to take a little bit for dividends and out, but forget that. Let's just assume the prefs convert. What's the company's EV at $6 per share right now?
Okay, so 500 million in cash, 1.2 billion in term loans, so 700 million net debt, term loan minus cash. You have the Honeywell pref, we'll just call it 600 million, so that'll get you to 1.3 billion, and then you have 6 times 313, which is going to be something like 1.8, 1.9. Something in that vicinity, I think 1.9, let's call it. So you had 700 plus 600 is 1.3 plus 1.9.
3.2 billion is about the enterprise value we're looking at today versus we think the target EBITDA, and though I think there's reason to think they will exceed it, but target EBITDA 6. So we're talking 600 million. So we're talking, if I'm doing my math right, a little bit over 5 times EBITDA right now. Is that about what you're looking at? Great.
On numbers that I think could be higher, but I get it.
Because I'm just looking, and we should have mentioned, I believe GTX is a cheapstock.com. Again, we're taping this Friday, May 14th. This will post Monday, May 17th. I think you're going to launch GTX is a cheapstock.com. We'll launch live so people can go there to see some more of your thoughts on GTX. But if you sent me some of your numbers ahead of time, and like, I'm kind of looking, docket 1000 was the company's last projections, I believe. And they said they thought they would do that 600 in EBITDA number in 2022. I think you think they could exceed 750 million in EBITDA by 2022.
Yeah.
And how are you getting to that number?
So there's the very simple, I mean, like, so they did about $1 billion in sales the last 2 quarters. So if you also look at that docket, I'm sure it says, I think it probably says in 2022, they're going to do like 3.4. That might be right. I'm not actually sure. I'm not sure if you have it next to you, what they actually projected the sales at.
You know what? You keep talking and I will find, here it is. I got it. Yeah. So total revenue, 3.8 projection for 2022.
Okay. So they probably had 3.8 and something like a 15-ish EBITDA margin, probably how they're back solving into 600 million.
That is exactly it. Yep.
15 to 16, somewhere in there. They used to do like 20% plus EBITDA margin. So we're going to, I'll come at it with like more info and then we'll boil it down after. But they used to do like a 20 plus EBITDA margin. And so to sort of, the number one issue they've had, right, is that like we had COVID and everything imploded, right? Like they did, to put that 15 in perspective, in a down 50 auto quarter, they did like a 14 something EBITDA margin. Like They had like down 50 sales and we had a 14. So I don't really think it's a screaming bullish thing to say we're going to gain 200 bips of margin as we double our sales, right? I think most people would say you're probably going to gain more than 200 bips of margin when you double your sales instantly. Not instantly, I guess 12 months later. The company used to operate at a higher margin than that. If you actually go, it'll be I think it's my slide, but like if you go to the Deutsche Bank Auto Conference in like July 2020, June or July, the chief technology officer of the company was asked about margins, and they basically said like, well, like if auto, like we think we can get back to like a 17 margin if like auto is like still sluggish, but kind of at these levels because we're going above market. Auto's recovered much sharper than that, and they've actually outgrown the outgrowth that they thought they were going to get. They said they're going to grow 400 or 500 bips above market. They just grew 1,000 in Q4 and 1,500, 15% above market in Q1. So they're actually coming in much higher than their actual numbers when they pre-filing said that they would be doing something like a 17 margin. And so the basic math is, look, their sales are coming in much higher. They used to do a much better EBITDA margin. The number one, some of the headwinds to their margin that have been showing up beyond the number one issue being the crash, right? But they were losing margin on like sort of like diesel had like been falling as a percent of their mix, and it's a higher margin than what's replacing it. But that's actually plateaued, it looks like. And commercial vehicles are actually coming back. We also see what Class 8 orders are and all that kind of stuff, right? And that's actually higher margin than the rest of the mix. So they basically have a number of mixed benefits coming. Not to mention, more important than that, in my opinion, they just have so much revenue growth right now. They're they have a very lean, efficient model, and so like to the downside, it's a bit painful because there's not so much to cut. But on to the upside, there's not that much to add either. And so the basic gist is like they said they wouldn't do more than 4 billion in sales until 2023. We're already running at $1 billion per quarter run rate, and we're growing 1,500 bips above the auto market, which itself is recovering and growing something like 10 to 15%. We talk about what exactly it's going to come in at, but like there's just a lot of growth to run through that, and so you sort of just like, oh, they're likely to leverage their structure a bit more, and then there's a lot of growth, and so you just get higher numbers. Like,
let me push back on one thing there, and I'm sure everybody who's listening loves to hear model critique without seeing a model or anything, but I think
terrible. Sorry.
Your EBITDA number is higher than their projections for two reasons. And number one, they think they're going to do about 15 or 16% EBITDA margin, and you think they can get back to 20%. And I think that argument makes all the sense in the world. But number two, you mentioned at the end, hey, they don't have themselves approaching 4 billion in sales for another couple of years, and you actually have them getting to 5 billion in sales by I think 2023, and they don't have anything like that, right? So they were projecting, and I'm just reading from the docket, they projected 2022 sales of 3.8 billion. 2019, pre-COVID, they did 3.2 billion. I think you think they could be 4.3 billion by 2022 and approaching 5 billion by 2023. So could you just talk, that sales delta is a big difference. So can you just talk a little bit more about why your sales numbers are so much further ahead of their projections?
So, sure. The first thing I want to is, I won't even have 2 points. They're currently growing, which is way in advance of their actual projections. Like it's what they are growing. Like they are currently growing well in excess of what they said. I forget what I want to say they said they would do like 700, 800 something in like Q1 sales or something like that. I mean, we came in like 25% above our projections 3 weeks after making them. Like it's not close to being accurate to what actually the business is running at. And it's sort of like, it's hard to see. They have a lot, so bring it back to kind of like the visibility of the company. They know what they're in. They know once they're on the product, they're in the market. They shouldn't be like shocked to find out that no one's going to rotate out them as a thing. It's not like, it's even like more competitive than like you could lose shelf space selling a consumer staple, right? You can't actually lose shelf space in this business model in comparison. And so they're already at $1 billion run rate. They are growing. There's a bit of seasonality to the business, which is basically related to like people take slowdowns in the fourth quarter to sort of like repair to whatever kind of stuff, and it's the holiday season. So there's a little bit of seasonality, but not tremendous. You can go look at what it's been historically, but we're already at $1 billion run rate. I think auto is going to continue to recover. I mean, auto sales, we had the largest post-World War II recession, like peak to trough decline in auto. So we're bouncing off that. I don't think there's any secular change in the auto industry that's going to drive overall car units per capita on a global basis lower. So we're just going to rebound off that. And so auto's growing 12% right now with very clear production shortages related to Suez, chip prices, all that kind of stuff. And so, look, they're at $1 billion. The background market is going to grow 10+% probably for at least 2-3 years. And then they're growing 15% above that market. I think if anything, it's hard to see. I mean, certainly can see them slowing from that, torrid pace, but like, it's hard to see how, if we're already at that rate, we're not going to hit much higher numbers, even modestly performing relative to what we're currently at.
Yeah. I definitely, on one hand, I agree with everything you made. On the other hand, like coming in, my two things, we said this is a better business because they have visibility. And then my pushback on this being super undervalued is, hey, this just got massively shopped and nobody paid higher. And like, again, it just comes back to management put out a projection. This thing just got shopped and it go higher. And then on the other hand, we're saying, oh, explosive growth that makes this thing dramatically undervalued and people had access to that. I guess that's on one side. On the other side, like, look, management had the deal wrapped up and they probably wanted to get their options struck at a pretty low level. So it probably does make sense for them to sandbag near-term projections once they were sure that the deal was going to get done. They kind of had the financing wrapped up because projecting 500 versus 600 million in EBITDA doesn't make much difference on the debt side once you've got that baked up, but it does make a lot of a difference for where your options get struck if you're trying to get rich.
Yep, they were certainly not incentivized to gun projections until now. And I will say now, I think that you're going to see them materially increase their estimates. They had a Q1 sort of earnings-ish call, but they didn't really provide any updated guidance, but they're clearly like, they're a little bit like, we're coming in a lot ahead of plan, right? Like drag your Excel, model to the right, just drag the cell and, you know what it spits out in a year or two. And so I think it's a material catalyst, but I think it's also one of the more obvious sort of like beat and raise setups to come in 30% above guidance and then like go like we're going to beat it again,
So look, I think both you and I think this thing is going to be a cash flow machine in the near term. And the near term, they've got to, you probably do a refi of the bankruptcy exit. You probably do the refi of the Honeywell. You probably need to get the convertible prefs to convert into common and everything. But in a year or two, this company is going to have to start having serious conversations about what do we do on the capital allocation front, right? Because we're throwing off a lot of cash flow. I want to come back to the business's long-term outlook in a second, but they're throwing off a lot of cash flow. What do you think with Senator Burridge Oaktree at the helm? What do you think capital allocation is going to look like? Is this going to be return of capital, or are we going to be talking about bolt-on acquisitions, something that I'm not thinking of right now?
I think it's that. I think it's exactly that. We're going to do some sort of version, and it's a little tricky because you have to figure out once the prefs are listed and how can we actually buy them back? Because you can't really buy that many shares. So there's if we're going to do a buyback, how are we going to execute it? Like, who are we going to buy it from? So there's a little bit of that. There's also dividend, like a straight up obvious return of cash. And then the more interesting part of that, not necessarily more interesting at a 4-5 times free cash flow when we're talking about like dividending it, right? That's a pretty juicy yield. But the interesting part will be like the M&A angle. And so, I think, Borg Warner basically is like, we're going to go buy high priced battery electric stuff. I think you might see these guys, which I think is a more interesting story, is like, there's maybe some interesting, legacy, quote unquote, internal combustion engine businesses that they could actually do some like M&A in. They have this nice tax rate. People had said that that's sort of something KPS was interested in actually when they were bidding for the companies. They could use it as a roll-up story. And so, yeah, I think you're going to see them come out. I don't think it'll take 2 years. They're going to come out with some sort of like, cash return plus maybe inorganic story. And then the other thing is like, if they're not going to be playing a role in buying things, I really don't think this company was fairly shopped because I think people didn't have an interest in making their return on 5% of the fund. They want 5% of the company. They wanted to own 50 and then have a return. And so, I think it's actually a pretty interesting M&A target, straight up. Like if you want to do a roll up of these legacy businesses that are trading at like higher yields, Garrett is probably, it's high margin, it's low corporate overhead. It's a very nice business to throw into a roll-up story if you're going to see. And I think you are going to see many of the German auto or European, let's say, auto suppliers are talking about spinning out their legacy internal combustion businesses because the world's going battery electric. And so like, I think with that kind of backdrop, certainly some private equity fund somewhere is going to take a shot at rolling up a lot of these legacy businesses. It's so funny to refer to something as legacy when it's 97% of the market. But I think you're going to see sane, reasonable capital allocation from the Centerbridge Oaktree group, and Tess is also on the board. I think you're going to see it laid out some point before the end of the year. I don't think it would, I think that everyone's sort of getting into their roles, but like, I don't think it'll take all that much time because I don't think it's really tremendously complicated to think about. We have a lot of cash flow. This business will shrink at some point. What are we going to do with the cash? And like lay out a plan,
I think you and I are both agreed. I would be a little bit surprised if this was still a standalone public company in the next 3 to 5 years. I think this is set up low multiple, good visibility, good cash flow, good solid cash flow. This is the type of business private equity was meant to own, maybe do some roll-ups, take advantage of those relationships and stuff. And, Centerbridge and Honeywell, they're going to be looking at after they convert all their prefs and stuff, they'll own, I think it's about 50% of the stock after they convert their prefs and stuff. You can get out of that two way. You can do a big secondary, which there's value leakage and a lot of people do that. But I think the natural way is sell the whole thing to a private equity company that keeps this thing properly levered, which is probably higher than the capital market, the public market likes, and just keep taking cash out of this, keep taking cash out. Let's talk the outlook, because you did mention it's funny that 97% of the business, 97% of the world's cars are still ICE. I think it's even higher than that, but that's the kind of legacy business. At some point, electric vehicles don't need turbochargers. Hybrids, I think most of them have it, though I did hear from some due diligence that a lot of the most popular hybrids do not have a turbocharger in them. But at some point, this becomes a melting ice cube. I do think one of your divergent opinions is that it's a lot longer than the market thinks. But how do you look at that melting ice cube risk for the turbochargers where an electric vehicle does not need that?
So I think, we're very geared in this very new economy growth kind of thing to think about how does disruption affect all these industries? And there's so many examples. But like the point I keep trying to make is like, I think people are a little bit used to seeing software disintermediation, where you push a button, you distribute your product globally at a zero incremental cost, and and we're funded by VC, so we don't have to make money for 10 years, and they just destroy existing businesses. And like, this is not software. This is a actual fundamental rethinking of like, I want to say global auto sales are like a $2 trillion industry. And then if you add in parts and repair and highways and all this other, there's a huge, huge thing. And you're like, there's a lot of physical infrastructure. And so one of the points to simplify it, I like to point out that like, to make the current generations of batteries, right, they require a bunch of cobalt, a bunch more cobalt than previously anything else needed. And so this runs into a sticky issue that 70% of the world's cobalt comes from the Congo, the DRC. The DRC is in recent and to increase to 30% battery electric penetration, which is sort of like the bulls on battery electric are like above that even. But I think most industry people are like, that's a good solid, like it's a tremendous growth to go from 2% to 30% of a giant global market, a $2 trillion industry in like 10 years. That's a huge growth rate. It's not like at all mild. But to see that, you have to have a 4x increase in actually cobalt supplies. And so you're sort of like, this is a country that is very much a frontier market. It has fought multiple civil wars. Parts of the country are under guerrilla control. 15 to 30% of their mining is, they call it artisanal and small scale, which is a polite way of saying we use child labor, which, as I would say, is, in addition to being wildly unethical, is also not really rapidly scalable. And so you're like, well, where is this product going to come from? And they're like, well, price, and there's a way, and don't get me wrong, but it's not, you cannot go from 2% battery electric, let's say last year globally, to 8% this year. You just couldn't do it. You like couldn't actually make the things. It's not the same thing as some of the other, it is not Netflix taking out Blockbuster. It is a much, I fully believe will happen. It is just, it's going to take a while.
Yeah, no, look, As you're saying, the reason software ate the world was because the marginal cost of software was zero. So as long as everyone had a phone, they could just open up software and disintermediate Blockbuster with Netflix. But in the real world, not that that's not the real world, but when you're dealing with physical products, as you say, whole supply chains need to get switched over and everything. And it reminds me of this is such a loose analogy, but I love cable companies and everybody, fixed wireless. Yeah, I guess fixed wireless is a risk, but right now your average mobile subscriber takes seven gigs of data a month, and your average broadband subscriber does 700 gigs or something. So if you're going to switch all of that kind of hardline broadband you're going to blow up the entire wireless system if you did even 4% of that tomorrow. So, and it's, again, looser because we're not Verizon and exactly employing child labor, but it's looser, but it's something similar, right? There's a lot of infrastructure that needs to be built up before you can even think about making that switch. And that takes years and years and years. Yeah.
It's not, I think it's going to happen. It does not scale the same way. Another one I just throw out is some statistic that in Europe, I think it's something like 70% of households are a single car household or something. I'm a little stale on these numbers, but it's in the ballpark of that. And so something like range anxiety when you have one car is a very real. When you have two cars, it's if we take a weekend trip, we'll take the other car and we'll put the kids and the dog in the back, right? Versus we have one car. So if we actually occasionally drive to grandma's house, this is a tougher bill. And then also on top of it, a tremendous amount of Europeans actually don't have a garage. Something like 50+% actually park on the street. So you actually have to redo all the streets, which you can do in 10 years. We can put charging stations all along, Broadway and Fifth Avenue, and we can redo it, right? But it doesn't happen overnight. It takes a while. So, yeah.
Cool. Perfect. Well, hey, I want to be cognizant of time because this has been a lot of fun and we've actually gone over an hour, but are there any points you wish we had hit harder? Any points that we didn't make that you wanted to get around to? Any kind of last thoughts here?
No, I think the only thing I would say is we haven't talked about the timing around the pref listing and what I kind of think are that I think is a decently interesting catalyst if you think about buying the equity around when it actually gets listed. I think you would actually see this used to be covered by 5 different brokers, all of whom have relationships with many of the parties involved in all of this. So I think you can actually see a number of people listing it. And once it's listed, I think you might see some sell-side coverage pick up. And a lot of people are going to be staring at their old model when they're it's complicated, don't touch it. And staring at it's a lot simpler now. So I think there is a nice earnings beat, relisting, resell side pickup coverage story that is pretty nice and catalyst rich in the next couple months.
That's perfect. Well, hey,
the website. Yeah. And then one final thing is so I'm throwing up a website, gtxisacheapstock.com.
Chris, you got to stop beating me to it. I was going to wrap up by telling people gtxisacheapstock.com. We're talking on Friday. It's not up, but Chris has promised me it will be up on Monday. The link will be in the show notes for that. So he's not going to let me down on getting the site up. Everybody should go check that out. I think GTX is interesting. I'll just remind everyone, Post-Reorg equity. We both have positions, so please, nothing is investment advice. Please be careful. But Chris, this has been a lot of fun. You run a concentrated portfolio, so there aren't a lot of new stocks coming in and out of your portfolio that we can talk to. But the next time you have an idea, you'll have to gin up a new website, and we'll have to have you back on because this has been awesome, and I've really enjoyed this. Really enjoyed swapping notes with you over the years, and looking forward to keeping it going.
Sounds good. Really appreciate it. Thanks.